All right, let's talk about investing. Today, we are going to pull back the curtain on a bunch of terms you hear all the time. By the time we're done here, you're going to know exactly what index fund and hedge fund actually mean, and more importantly, how they really work. Okay, so you've heard these words thrown around all the time, right? Index funds, mutual funds, hedge funds, ETFs. I mean, they can all start to sound the same. A bit confusing, kind of interchangeable, but what's the real difference? And maybe the most important question is, who are these things actually for? Look, our goal here is pretty simple. We're going to give you the kind of knowledge that honestly takes most people years to really get, but we're going to do it in just a few minutes. No confusing jargon, I promise, just the stuff you need to know. So, before we can get into comparing all the different types, we got to start with the absolute basics, the foundation. So, what even is an investment fund? At its heart, a fund is just a big pool of money. That's it. A bunch of different investors, people like you and me, all put their cash into one collective pot. And then that big pot of money is used to invest in all sorts of things. We're talking stocks, bonds, maybe even real estate. Really, it's as simple as that. You know what? Here's a perfect way to think about it. Imagine you're all throwing a massive birthday party. Instead of one person having to pay for everything, which would be crazy expensive, everyone just chips in a little bit of money. With that pooled cash, you can buy all the food, all the drinks, all the decorations for a really great party. Well, an investment fund is just like that party budget. And you're one of the guests chipping in. Okay, so now that we've got that foundation down, let's dive into our first thing category. It's what we call the passive approach. And honestly, this is the starting point for most people when they first get into investing. And this brings us straight to the index fund. Now, an index fund's job is not to be some kind of hero trying to pick the next big winning stock. Nope. Its one and only goal is to perfectly copy or mirror a specific list of companies, what we call an index. So it's not trying to beat the market, it's just trying to be the market. That's why we call it passively managed. It's just following the leader. So what exactly are these indexes it's copying? You've definitely heard of these. There's the big one, the S&P 500, which is basically a list of 500 of the largest companies in the US. Then you've got something like the NASDAQ, which is super heavy on tech giants. Think Apple, think Microsoft. And of course, there's the Dow Jones, which tracks 30 huge, really established industrial companies. An index fund's job is just to buy a tiny slice of everything on one of those lists. Now, you're probably thinking, what about ETFs? You always hear them mentioned in the same breath as index funds. And you're right, they're super similar. They often track the very same indexes. But here's the key difference, and it's all about how you trade them. A classic index fund gets priced just once a day right when the market closes at 4 p.m. But an ETF, that's an exchange-traded fund, you can buy and sell it all day long, just like a regular stock. That's pretty much the main difference you need to know. And here's the best part. Because these funds are just passively copying a list, they are incredibly cheap to run. I mean, really cheap. The annual fee, what they call the expense ratio, can be as low as 0.02%. Think about that. On a $1,000 investment, that means you'd pay just 20 cents for the whole year. It's almost nothing. Okay, so if that's the whole passive idea, what's the other side of the coin? Well, that would be active management. And this is where things get interesting, because this is where you're actually paying a pro to try and do better than the overall market. And this brings us into the world of the mutual fund. See, unlike an index fund that's just mindlessly copying, a mutual fund has a real live professional manager, or sometimes a whole team of them. Their entire job is to constantly research and handpick investments they think are going to knock it out of the park. Their goal isn't just to match the market, it's to beat it. Now, on the surface, that sounds awesome, right? Why wouldn't you want a pro trying to get you better returns? But, it kind of leads to the obvious question, what's the catch? Well, the first part of that catch is the fees. I mean, paying a whole team of finance pros to do all that research, it isn't cheap. A pretty typical fee for one of these actively managed mutual funds might be around 1.5%, maybe even more. Now, let's compare that to the 0.02% we just talked about for the passive fund. That is a huge difference. And over time, that extra cost really eats into your returns. And that brings us to the second part of the catch. And honestly, this one's a biggie. The hard truth is that study after study has shown the same thing. The vast majority of these active funds just fail. They fail to consistently beat their simple, boring, passive index fund cousins over the long haul. And why is that?
Well, think about it. Because their fees are so much higher, they have to do way better than the market just to break even with a cheap index fund.
All right, let's shift gears completely. We're about to enter a totally different arena now. And I gotta say, this is not for most people. We're talking about the high stakes game, the pros only club.
Yeah, we're talking about hedge funds.
And the absolute first thing you need to know about them is that they are exclusive. You can't just sign up. You usually have to be what's called an accredited investor, which is a fancy way of saying you have a really high income or a high net worth. Otherwise, you can't even get in the door. So why all the secrecy and exclusivity? Well, it's because hedge funds play a different game. They use much more aggressive, much more complex strategies to try and get those huge returns. We're talking about things like short selling. That's where you're actually betting a stock's price will go down. They use leverage, which means they borrow a ton of money to make their investments even bigger. And they get into really complicated stuff called derivatives. It is a world of very high risk for the potential of very high reward.
And their fees? Oh boy. Their fees are in a completely different league. It's famously called the 2 and 20 model. Here's how it works. They typically charge a 2% management fee every single year, just for starters. And then they take a 20% cut of any profits they make for you. So think about that. They have to perform incredibly well just for their investors to come out ahead after those fees.
Okay, we've covered the passive approach, the active alternative, and the high stakes game. So let's wrap this all up. What's the final takeaway here? All right, here it is, the cheat sheet. For most everyday, long-term investors, the simple, passive, super low-fee index fund or ETF is going to be the go-to choice. Mutual funds, they're really for people who truly believe a specific manager has some magic touch and are willing to pay those higher fees to take that shot. And hedge funds, well, they're a specialized, high-powered tool for wealthy investors who are totally comfortable with a lot more risk and a lot more complexity. And hey, you don't just have to take my word for it. The legendary investor Warren Buffett has been saying this for years. He's on record saying that for the great majority of people, a simple, low-cost index fund is the single most sensible investment they can possibly make. So at the end of the day, it's not about one of these being good and another being bad. That's not the right way to look at it. They're just different tools in a toolbox. And the whole point, the crucial thing, is understanding which tool is designed for which job. The key is figuring out which one fits your specific needs and your goals. So there you have it. We've broken down the types, the strategies, the costs, everything. You now have the kind of core knowledge that, seriously, takes most people a long, long time to figure out. So the only question left to ask is, what does your investment path look like?